In a surprise move, Japan's central bank has adjusted its monetary policy, allowing long-term interest rates to fluctuate in a wider band than before. And if we have not met before, this is Rohan Paul, and in this video I will discuss the interest rate action that Bank of Japan took today that took the entire financial world by surprise. So with today's action, the Bank of Japan allowed the yield on 10-year Japanese government bond to swing 50 basis points on either side of its 0% objective. Their decision came amid pressure for the Bank of Japan to join other central banks to raise interest rates. But here is the point to note. The central bank kept its yield target unchanged, which is set at minus 0.1% for the short-term interest rates and around 0 for the 10-year bond yield. Bank of Japan said it will sharply increase bond buying, which is a sign that the move was fine-tuning of its existing ultra-loose monetary policy rather than a withdrawal of stimulus. The yen surged to a 4-month peak against the dollar after the news, briefly touching 132 from 137.16 immediately before the decision. The yield on 10-year Japanese government bond jumped to 0.46% from the previously capped level of 0.25% following BOJ's move. Japanese bank stocks surged in afternoon trading as investors expected improved earnings from financial institutions. And the ripple effect also spread far outside Japan, with the fallout touching everything from US stocks and index futures to the Australian dollar gold. Global equity and bond markets will see seasonal hopes for a rally disappear now. Higher bond yield mean unrealized losses on Japan government bond holdings, including those held by the BOJ. But the bigger concern for the rest of the world is that it could cut loose the last remaining tether on global bond yields and trigger a sell of dollar assets in favor of the yen. This rate tweaking by BOJ ended a year where virtually every major central bank has tightened, with China being a notable exception. Most BOJ watchers had expected no change until the current governor Haruhiko Kuroda's 10-year term ends at the end of March 2023. So this was really out of the box. The writings on the wall is now clear that perhaps the sharp yen weakness that we have seen previously was uncomfortable for Japanese policymakers. It's clear now that this action adds to the yen strength story next year. Traders describe the move as potentially marking the long-awaited pivot by the BOJ, which is the last of the world's major central banks to stick to a ultra-loose regime of avoiding raising interest rates to tackle global inflation. Tuesday's market gyration highlights just how tricky it will be to reverse policy given the combination of unorthodox moves supporting the Bank of Japan stimulus, which is keeping negative short-term interest rates, pinning 10-year yields near zero, making massive asset purchases and government interventions in currency markets to counter the yen's fall. So, any misstep by the new governor will trigger market turmoil on a global scale. Now, looking at the inflation part of the story, Japan's core inflation, which excludes volatile food prices, has exceeded the BOJ's 2% target for the 7th consecutive month, hitting a 40-year high of 3.6% in October. But Kuroda had long argued that any tightening would be premature without a robust wage growth, which is why most economists had expected the BOJ will stay the course until he steps down in April 2023. On Tuesday, BOJ maintained its outlook that inflation would slow down next year and warned of extremely high uncertainties for the economy. Now, here is the important part. Governor Kuroda made it clear that the move was meant to iron out market distortions and that it was not an interest rate hike and not a review that will lead to an abandonment of yield curve control or an exit from the easy policy. Its focus remains on keeping borrowing cost low to stimulate the economy. Kuroda had earlier said that any tweak to the yield curve control would effectively amount to an interest rate increase. But on Tuesday, he said the adjustment was meant to address increased volatility in the global financial markets and improved bond market functioning to enhance the sustainability of monetary easing. Now, it is the largest adjustment in a 6-year experiment with their so-called yield curve control program. But rather than providing breathing room, some investors say it is likely to encourage more of the sort of pressure that has bent the bond market out of shape. For the overall macroeconomic effect of this action, note that Japan is the world's largest creditor, and tightening domestic financial conditions may result in a wave of capital returning home that threatens to push down asset prices and boost global borrowing costs at a time when the economic outlook is already deteriorating. Investors are expected to exit bonds in the US, Australia, and France and bring that money back to Japan to achieve the higher bond yield. And developed market equities are also likely to decline. Japan's benchmark 10-year yield jumped as much as 21 basis points to 0.46% before dropping back to 0.4% after the BOJ also announced unscheduled debt purchase operations. Trading of Japanese bond futures was briefly halted by Osaka Exchange after they hit a circuit breaker threshold. The yen strengthened as much as 3.5% to 132.28 per dollar. The BOJ governor Kuroda is famous for his reputation of catching the market off guard. So the decision to double the trading band of the 10-year Japanese government bond was another masterclass in timing from him. With just 2 monetary policy meetings left before his term expires in April 2023. And what a surprise this was. The adjustment made in July 2018 and March 2021 were preceded by media reports on upcoming changes, including a full sell leak last year of how much the 10-year JGB trading band would be widened. This time there was nothing, not even a hint that some changes were coming. There is one key question that is dividing the market right now is this, that is this a last surprise for Kuroda or the first step in a tightening policy regime that will be continued under his successor from next year? Now, noting that he confirmed that this measure is not a rate hike, so what I think is Kuroda has made a policy somewhat less loose, of course, but it's a long way from being a tightening of policy. The era of easy money continues. The benchmark rate is still negative and the BOJ still says it is prepared to ease further if necessary. Indeed, he said today's changes could only make yield curve control even more effective and sustainable, and he stuck by his view that inflation in Japan will pass. Alright, now let's see some of the views from Twitter on this topic, because this was super hot topic today. So here John Turek is saying, I think what happened last night, last night's BOJ was not just a one-off tweak like in 2018. Something has changed. Then in this tweak, Peter Schiff is saying the Bank of Japan blinked and pivoted in the opposite direction after artificially holding the 10-year JGB yield at 0.25%. The BOJ just raised the target rate to 0.5%. More hikes are coming. In the US, this means the dollar and asset prices will fall and inflation will rise. Next one here, it's like the BOJ is taking lesson from SBF FTX. When you own over 50% of a market, is it even a market anymore? And this is referring to the Japanese government ownership of BOJ JGB bond, which is beyond 50%. And then this view from Samantha Laduke, BOJ move in a nutshell, last global anchor to keep borrowing cost low has given up. Costs are going to rise as economic growth slows, stagflation. Bulls, give up on your higher tech multiples. It's over. And she further says, my client answered this question best. Japan is the biggest creditor to the world. If the money goes home, we have a real problem in global liquidity. That pretty much wraps up this video. If you liked it, do smash the like button. And also don't forget to subscribe. See you in the next one.